Good evening and a very warm welcome to all the participants to Credit Avenue's webinar. Today we would be discussing the success story of Infra.Market and how they are revolutionizing the infrastructure supply chain in the country. My name is Sharda Bhaskaran and I head the sales vertical for the retail pawn platform at Credit Avenue. For the discussion today, we are privileged to have both the founders of Infra.Market, Mr. Souvik Sengupta and Mr. Aaditya Sharda. Mr. Souvik is a chartered accountant with more than 12 years of experience in infrastructure and construction, an alumnus of IIM Bangalore. Souvik did his graduation from Sydenham College, Mumbai. Souvik heads the finance and investor relations team at Infra.Market. Mr. Aaditya brings more than 10 years of entrepreneurial experience in the field of infrastructure and construction and is an alumnus of IIM Ahmedabad. Aaditya leads the operations and sales verticals at Infra.Market. In terms of flow, we will begin with a discussion with Aaditya and Souvik and then take questions from the participants in the second half of the session. I would request all participants to share their questions in the chat box, which will be taken up later. So to begin with Aaditya and Souvik, if you could start off by explaining the genesis of this idea, and if you could spend time on your background and the vision beyond starting this enterprise.
Sure, I'll take that up first. Me and Aaditya have known each other for almost, I think, around 20 years now. So we've been friends for a long time. And the genesis of the idea, so I had a lot of, like you mentioned, I worked a lot in infra and construction, whereas Aaditya has worked a lot in the entire building material space, has a more entrepreneurial side to it. So when we sort of look at how construction material worked in India or how it operated in India, we realized there were gaps in the way construction metal supply chains worked. Manufacturers took a lot of time to reaching out to the final consumers and distributors in India. And most of the manufacturers were sitting on idle capacity. And many of the large companies in India were single product companies. So you had a company in tiles, which primarily did tiles, or you had a company in steel, which primarily focused on steel. And they were not horizontal companies focusing on construction material value chains in a more holistic manner. So you don't have someone who is across multiple products, building out supply chains for multiple product categories. And that's where the genesis of the idea came. We wanted to build out India's version of Home Depot, but we also wanted to make it more vertically integrated. Not only wanted to build the platform, but we also wanted to build vertically integrated brands within that structure. So we wanted to own the brands also. So our focus area was very simple, that we decided instead of setting up large manufacturing facilities, we will set up micro manufacturing. We'll tie up with micro manufacturers spread across the country, buy out small capacities, and basically contract manufacture our products, create our own brands, look at quality, look at fulfillment at the manufacturing level, and go directly from manufacturer to consumer. That's the sort of area that we focused on. We started in 2016, primarily with concrete, primarily in the west of India. And today we are across 10 product categories, from concrete to electricals to flooring, across 10 to 12 states in India. And we are fast expanding. I think over the next couple of quarters, we'll become a pan-India company with presence across all the states in India. I think that is where we are at currently. And I'll let Aaditya give his intro and sort of the background himself.
Yeah, hi, and good evening, everyone. Pleasure to have an interaction with all of you. So, as Souvik said, I think that we have been into this industry cumulative. We have more than 20 years of experience as founders. We are business first founders. So, as Souvik said, we have been into this industry cumulative. We have more than 20 years of experience as founders. We are business first founders. So, as Souvik said,
Rajni? Yeah, Aditya, sorry.
Yeah.
Sharad, can we continue?
Yeah. So as I was saying that cumulatively we have about 20 years plus experience in building material space. And as Souvik said, in very simple words, we are a one-stop solution of all construction materials. The products that we deal into are concrete, cementitious products like concrete, cement, aggregate, sand. We have recently gone into finishing side of the products as well, where we have launched Infra.Market tiles, bath fittings, sanitary, electrical, that's LED lights and fans. We aspire to look at even categories such as modular kitchen very closely. I think modular kitchen fancy hardware is something that's on our radar. Apart from that, we also have walling solution steel as a part of the product portfolio. So our idea is very simple, that if anybody is building out any construction material, any construction company, be it on the infrastructure side or on the real estate side, or an independent house builder, all the products that we would require, we want to sell it under one roof. That's the very vanilla idea that we are working on.
Interesting. So Souvik, if you could give us an overview of the competition landscape in terms of both direct and indirect competition, and also what would you identify as the moat for your entity?
I think one of the largest, one of the most important aspects to look at is that we are not here directly competing with large manufacturers. So if you look at any space in construction, so you look at tiles as an example, you have the large brands, you have the large branded, we all know what the large brands are, like the Kajarias or the Johnson Tiles or the Vermoras of the world, which are currently at around about would have around 30 to 35% market share, right? So I think the way it's currently sort of structured is that 65% of the market is created by unbranded players. Now the unbranded players typically suffer from a lot of issues with related to quality and fulfillment. So what we are trying to do here is that we are opening up markets for these unbranded players, taking care of their quality fulfillment and opening up newer markets to a local manufacturer. So we are not competing with the large branded players. We are essentially opening up within unbranded players. We are improving the product quality that they can offer to their customers. So let's look at a small manufacturer based somewhere out of a tier 2 city. He cannot compete beyond his immediate geography because he does not have the bandwidth or the resources to build a channel like the large brands built out. So we're enabling them to build out a plug and play channel. So basically, they can plug into our ecosystem and reach out to the final consumer, whether it's a direct consumer guy building his own house or it is someone building a road. We are opening up the channel for them. So our competition essentially are other unbranded players. And essentially what we are trying to do is that we are trying to assist the better unbranded players to essentially partner with us and create their market share. In terms of new age companies, there are a couple of companies in this space, but nobody substantially large. There are obviously a lot of B2B companies in this space, but I don't think anyone is trying to create brands. Most of the B2B companies today are building out B2B commerce platforms. Like I said, we don't want to only build the platform. We want to be vertically integrated into creating brands. And our thesis is that we will create India's first horizontal construction material brand. So we will create that first brand in India, which operates from paint to tiles to all product categories, and it doesn't have a heavy manufacturing base. The benefit of that is when you don't have a heavy manufacturing base, you're not product centric. The difference, I'll say that once you have a heavy manufacturing base, your entire thesis or resources are spent on trying to ensure that your manufacturing base is utilized well. And you're not instead focusing, say you're selling to a retailer and you have a large tiles manufacturing base. Your complete focus area is how do you sell more tiles to that retailer. Instead, what we are trying to do is buying out small capacities across multiple manufacturers, is that we want to be able to sell everything from tiles to paint to steel. And it doesn't matter to us what product category we are selling, so long as we increase our wallet share in that retailer's business. And that's what we are focusing on. Hence, I think one of the best moats we have is the lack of manufacturing capacity, the flexibility and agility that gives us, our ability to go beyond geographical, because every manufacturer has a geographical region he can't go beyond, and our ability to scale up and scale down very quickly. Because when you don't have manufacturing, when you're asset light, you can increase your capacity based, and your capacity is very elastic. You can increase it based on the demand you have, or you can reduce it if the demand is low. I think that sort of gives us an agility to actually cater to market demands. COVID was a great example. Suddenly, a lot of the small manufacturers were struggling with supply chain. A lot of orders came to us, and we could immediately scale up supply chain at a scale which, if we were an ordinary manufacturer, we would have found it difficult to do. So I think COVID sort of made us realize that we could grow 10x, because we suddenly had 5x, 6x demand in certain places, and we could cater to that. So I think that is where I think our greatest moat comes in, the kind of agility and scalability we have compared to a traditional manufacturer.
Sure. So Aditya, if you could please elaborate to our audience your major product categories. Souvik was saying, despite being a relatively newer player, you have grown to become the top 2 or 3 player in many of the product categories that you operate in today. And in terms of strategy, what would you attribute this to?
So I think the large product category for us remains cementitious products, right? For a very reason is we were bootstrapped for 3 years, right? And while we were bootstrapped, we always maintained our profit margins were profitable from day one. So then it always made sense to get into product categories which are fragmented in nature. Right. See, if you pick a product category which are established, something like a steel and cement, there is very less to crack in that, right? Because these are evolved industries. They have been for a very long time. They have an established logistics and supply chain, and they also have a good sales network. Right. The more you go on the product categories which are fragmented or are owned by local players, that is where the real margin lies because nobody has gone to that level in the supply chain to fix all the points, right? So that is the reason that since a very early age of the company, we were always into product categories which offered a higher share of gross margins, right? So being said that, I think cementatious products have always been a strength. In concrete today, we are number 2 player at pan India level, right? We are number 2 to Ultratech. We've already beaten up. We have already crossed the volumes of ACC or a Prism Johnson who have been into this business for more than a decade, right? So concrete remains where we are number 2 at a pan India level. We have the concreting facilities almost all states in India. Apart from that, aggregate and sands remains again one of the categories where we would be the biggest player in India at a pan India level. Where we supply aggregates and sand across all regions. So a lot of large companies like Ultratech, like L&T, like KEC, lot of prestigious infrastructure projects, we supply a lot of aggregates, that is stone chips and sand to all of them. So I think these cementatious always remains the largest category for us. Apart from that, as I said, we have recently gone into finishing product categories. We've launched the tiles, bath fittings, and sanitary ware. We also launched Infra.Market LED lights, fans, and fans.
Sure, Aditi. And also in terms of your journey till now, you have evolved from being a pure B2B company to also having a B2B2C strategy. I understand through your flagship and dealer stores. How do you see this panning out in the coming years in terms of volumes, margins, and also wanted to understand the mix between private label and other brand products in your overall portfolio?
Right. So Sarat, if you see, for us, any product is a function of supply chain, right? We are a supply chain first company. So the idea is once we fix a supply chain of any product category, right? The idea was why stick only to B2B. During the COVID time, when the first wave hit, we were largely a B2B company having a lot of exposure to the infrastructure and the construction companies, right? That is when it synced to us that it's time that we should start de-risking ourselves. We should have various other networks where we can supply material and have better margins, have better brand play. So that was one reason that got us into retail. The second reason that was very critical for us to get into retail, if you see a brand play always happens at a retail level. A brand is built at a B2C level, and even the brand recognition at B2B level is recalled from there, right? So unless you don't make a brand for a consumer, a real estate player will not go ahead and buy it, right? A consumer need to know that there's a Kajaria tile or there's a Kohler bath fitting, and that is exactly why a real estate player would go and procure it. So if you see construction material, even B2B, the brands are never made in B2B, they're always made in B2C or the retail, and that is how the flow happens in the B2B. So these two remained a very important reason for us to focus into retail. And as I told you that I had the supply chain fixed, right? So if I have a supply chain fixed for myself, so we wanted to expand that and go from B2B to retail, and eventually at some point of time we will also get going direct to consumer.
Yeah. And in terms of the split between your private label and other brand products, what would be the share currently?
I think today at a private label, in a lot of categories, we are at a blended level, we are 65% is private label, right? And 35% is still in the other products. So in large categories like steel, right? Of course, we have not gone private label. As I told you, these are very evolved categories, right? You cannot really do. Why we of course aspire to become private label at some point of time in a outsourced manufacturing model, right? But today the scope of private label in that is very thin. But in a lot of categories, walling solutions, your wall putty, gypsum plasters, mortars, concrete, all of them, and the tiles and all, we have already become private label in that.
So, kind of just dig a bit deeper into this product portfolio, I understand that we have been using acquisitions as a strategy to expand our product portfolio. So, if you could just walk us through our acquisition strategy and also give a color of the impact that it had had on the profitability of our enterprise.
Right. So as I told you, see, sir, the idea is that we've always first focus on building a distribution network or a sales network. The sales network can be into B2B space. It could be into retail space. In retail, again, we have the distribution space and we have franchisee space. The moment my sales network is established, right, then we go, that is a time that the first sales may happen as a being a distributor of some company, and eventually go and fix the supply chain and launch a private label. So there is always a time where we have been distributors first in all product categories. No, idea is when you have developed and evolved a sales network, right? You would not like to work only at a distributor level margin, right? It always makes sense that you go backward integrated and try to work on a manufacturer's margin. While of course, because we are asset-light manufacturing, we may not clock the entire wallet share or the entire margin share of manufacturing, but we largely try to take up at least 70% share of what a manufacturer would make it, right? So because we have a certain volume commitment already, we are already using only the excess facility that we have, right? And that takes care of the operation cost. So we are able to source at a very solid pricing, I would say. So being said that, we backward integrate and launch privately. Okay, so and these private label would ultimately, the brand play, the network play, and the private label is the play that we believe would give us the highest share of the margin.
Understood.
So I think the one point I would like to add on to acquisition strategy is that we obviously have tried to create a lot of brands ground up. So concrete, we have created ground up. Aggregates, Aditya said, we are the largest player in India today, ground up. Chemicals, we are creating ground up. But there are some categories where in creating ground up will either take a lot of time, or we already have a network of customers built, both in B2B and retail, where customers want the product from us. And we already have distributing other brand products, where we believe ground up will take a lot of time. So we may decide to buy out an existing smaller brand and plug that into our sales channel. So I think that is where the acquisition really plays through. We are looking at acquisitions where there's a synergy benefit. We can plug it into our existing channel, and creating that ground up would take more time in the build versus buy sort of decision making. And we've gone ahead with build decisions. But when we acquire, these are typically revenue generating and EBITDA generating companies. So the profitability does improve overall, but the focus is not that. The focus is there are product categories where we can actually scale up easily, considering that we have the channel built up.
Understood. And on the profitability bit, I think one of the biggest distinguishers for you compared to many of the other platforms in the country has been the strong profitability numbers. I understand that we will be closing this year with an EBITDA in excess of 400 crores. So from a business standpoint, if you could give us some color how we have managed to be supremely profitable while ambitiously scaling volumes in terms of our growth.
So I think what we have distinguished ourselves very clearly, like Aaditya mentioned, is that we are 65% private label. I think if you look at most commerce platforms, B2B commerce platforms across India, they are either just starting out their private label story, or they would be 5 to 10% private label. So the fact remains that distribution businesses will have a curtailed profitability margins compared to companies which have their own brand. And we've seen that across B2C, we've seen that across D2C companies, right? When companies launch private labels, their margin profiles jump up substantially. And we focused on that part of the business from the day one. And so I think that has helped a lot. Having 65% private label means that there are these great profit pools that we are tapping into, where we work at an EBITDA level of close to 8 to 9%, easily in the private label space. In the non-private label distributed space, our EBITDA would be closer to 5% sort of maybe. So at a blended level, we are close to 7% EBITDA. which is where the 400 crores is currently coming from. But also remember that we are growing into multiple geographical locations. And unlike traditional manufacturers, we can't set up manufacturing capacity in one part of the country and sell to multiple areas. So we are always incurring cost when we are going into a new geography. And today we are not present across India in all these geographies. So there's a lot of cost built into that 400 crore EBITDA, which is sort of non-recurring in nature. So I think over the next couple of years, at least next year, what we are targeting is close to 1,000 crore EBITDA number. And I think that is a possibility, considering that there's a lot of front ending of costs that has happened at our end this year, where the revenues will only come in the next couple of quarters. For example, we built down supply chain, like Aaditya said, in tiles in Punjab, MP, we've gone and built it up in Odisha, West Bengal, where revenues are very nominal today. So while we are incurring cost, employee cost, a lot of fixed overheads. So I think those numbers are today. So our EBITDA today, while it may be 7%, I think the way we are tracking over the next couple of years, we should be a 10 double-digit EBITDA.
Understood. Just a reminder to the audience, would request you to please ping your questions in the chat box. We'll take them shortly. Moving on to the fundraising part, Souvik. So recently, the expectations regarding your next round of equity raise created quite a buzz in the markets. Could you please walk us through your equity fundraising till now and the roadmap that you would have towards listing?
Yeah, so we have around 55% of the company today held by foreign investors, and around for the balance 45% is held by founders and employees of the company. We've raised around 5 rounds of equity total. The first round was raised in June 2019. It was the seed round. It was a 25 crore round. Axel was the lead, and Axel was the only lead investor in that round. We then went on to raise a 150 crore round in December 19, where Nexus and Tiger led the round, and Axel also participated in the round. This was our A round, and the Series B then happened, another 150 crores. This was around October 2020. This was led by Evolvence and Systema, and the Heidelberg Group participated through their investment arm, Fundamental. And they were one of the, and then you had the existing investors also participating. And again in 2021, we raised 2 rounds of capital, primarily led by Tiger, but all the other investors also participated. And that took the total, and we raised around about 1,600 crores last year. So that took the total amount of raise to around 2,000 crores of equity that we've raised through around about 2.5 years of this journey. 1 year of this was obviously COVID impacted, but we've raised substantial equity. We are well capitalized in that front. We are under talks to raise another round of equity. Obviously, the discussions are underway, and we think over the next couple of months maximum, we should be able to sort of have this in place. We are looking to raise another 200 odd million sort of in this round. And that will again capitalize us for further acquisitions that we may look to do.
So we have a question from Abhishek Khandelwal from Valides Wealth. So his question is that given that the company is changing its avatar from a pure marketplace to a manufacturing through acquisitions, will that open us up to inventory price risk and capital heavy business?
It won't open us to capital heavy or inventory prices model. See, we are not essentially acquiring the manufacturing capacities. What we intend to acquire is the brand. Our thesis is acquire the brand, plug it into our sales channels, and try and grow out sales, try and grow out revenues, and basically sell that product category to our existing customer base. Now, in that, we will acquire certain companies which have existing asset bases. Now, when you acquire existing asset bases, you have two basic decision-making points. Do you want to keep the asset base, or do you want to carve it out and give it to contract manufacturers? So some places we will take that call, where we will carve out the assets and give it to a contract manufacturer. The second part will be where you want to keep the asset. Now, we'll also have to realize that as a pure marketplace, also asset light is impossible. I mean, one of the greatest asset light companies is Amazon, right? They have warehouses all over the world. So it's not, you're not going to be asset light. You're not going to be zero asset. You can be asset light. So I think the way to look at it is that certain percentage of our revenue will always come from own manufacturing. And that will be a very nominal percentage, but that will be critical strategic assets acquired across India, which will serve as a minimum requirement that you need when you start scaling up. You're talking of a company, for example, as ours. Today in concrete, we have 8% market share. Okay, Ultratech has 10%. So we are very, very large in concrete. Now we cannot have zero, we cannot have no assets. We need some strategic assets, so that even if 90% of our output is contract manufactured, we have that 10% that is coming from our own units, which serves as a fallback position in case something goes wrong. Right?
Yeah,
I think those minimum assets will always be required.
It's more of a de-risking policy, right? There have been a major situation where there's a lot of disruption that happens in the supply chain. That's because of a lot of fluctuation on the raw material side, a lot of global fluctuation, right? As a company, when you are doing sales at such large scale, you want to de-risk. So manufacturing, asset-based manufacturing is a part of the strategy where we want to de-risk ourselves and have a hedge, right? There has to be some minimum product that we have to throw in the market. We don't want to be in a situation where we are largely or completely dependent only on our contract manufacturers, right? You don't want a situation where at scale you get the risk of there have been instances a lot in the past that a lot of these vendors gang up, right? So it comes more of a de-risking policy to us, right? And it also gives us a better control on our raw material purchase price, right? If we have an asset base, the way we are looked upon by the vendors who supply raw material is very different, of which we pass on the benefit to the vendor. So it's more of a de-risking strategy.
And even if we have assets, they'll be nominal and strategic. For example, if you're buying an electrical company, you may decide that all your electrical manufacturing happens by contract manufacturers, but you may want to keep the assembly in-house. So there's going to be some strategic takes that you will have to do as you scale this up.
Right. So the next question that we have is from Pankaj Bhandari. So what he essentially wants to know is 5 years down the line, how do you see the business panning out? Will we still be restricted only to construction materials, or would we be expanding the scope from there?
I think majorly today, the way the bandwidth of the company is, I think we will be majorly restricted to construction and building materials. That includes a lot of consumer products also. So when I say consumer products, look at home decor as a industry, right? Look at a lot of the what people buy at their homes for furnishings as a category. I think a lot of categories that we'll go into that is beyond the traditional building material category, but I think we will remain in the overall sort of that space. 5 years down the line, we intend to become one of India's largest building material companies, construction material companies, and one of the largest brands in construction materials, which is horizontal in nature. But we intend to remain in this industry.
I think what I would like to add is you can assume that it will be a home improvement company. From a pure building material company, we'll also have a segment of home improvement, right? That will have, as Souvik said, a lot of furnishings, right? A lot of interiors. Okay, there's a lot of value still there on the furniture side, on the modular kitchen side, right? So home improvement could be a category which would like to gradually evolve into.
Right. So also, Aditya, there are a couple of questions on the quality control, right? Especially given that we would be expanding into some of these newer product categories and increasing the share of our white label offering. If you could just walk our audience through the quality control measures that you would have in place. Also, if you could touch upon some of the key personnel that you have to head each of your verticals.
So, yeah.
I'll take that one. I think me and Aditya. So I'll take that one first, and Aditya can sort of add on. First of all, on the people side, so we have some of the so if you look at our team from concrete is headed by someone who was the ex-head of concrete for ACC. Our team for chemicals is someone who had worked with Asian Paints, who one of them is a national head for Chryso. So we have a lot of our steel head was ex-Vedanta group. Our electricals head is ex-Asia Pacific head of Stanley Black & Decker. So we have a lot of team members who've spent a lot of time building out supply chain, understanding quality, understanding how products get manufactured, in India. I think what we've done very well is use technology at the supplier side to control that space. For example, I'll give you concrete. Concrete, we work with almost 150 manufacturers across Infra.Market and RDC, 150 plants that we work with, right? So in these 150 plants, we have sensors, softwares put on these plants, which give us real-time access to how much cement is being used in every cubic meter of concrete manufacture. This is irrespective of whether we own the plant or not. We get access to what raw materials are being used, what processes are being followed, what quality mechanisms are being followed. So I think the entire sort of value chain of the quality can be monitored by us on real-time basis and gives us access to that manufacturing unit beyond even beyond what a owner would have. So even if we own the plants, we have real-time access to each and every aspect of the plant, each process that is happening at the plant level. So I think that is where our real the benefit of our technology solutions come in, and that is how we intend to control quality across multiple manufacturing units. And I think this will evolve as we go into more and more manufacturing units. So as we go into granites, the quality parameters are different. As we go into, say, chemicals, the quality parameters are different, and we built out different tools to actually sort of measure, first of all, calibrate what quality parameters need to be implemented, and then measure that they are being followed. So I think that is very critical to our overall supply chain process. I think we've sort of built that out pretty well so far in the product categories we are in. But again, that will evolve as we go into new product categories. Obviously, the quality parameters that work for concrete will not work for electricals, right? So we'll have to also do our sort of combination and understand each vertical. But I think that is how we intend to sort of, the way we built it out, the same playbook we intend to sort of implement over there.
I think there are some questions around the sourcing bit. So, for example, Dhaval from Access Mutual Fund wants to understand why a large EPC infra company would directly come to our platform, rather than directly buying. In terms of the cost saving.
So I'll tell you an example. We were working with the EPC company in for the Mumbai-Nagpur Samruddhi Expressway, right? So a couple of EPC companies there. So that they had two options. They could buy from a large, they needed waterproofing chemicals. They were buying for that project. They could buy from a large manufacturer in, who is 100 kilometers away, and pay for that cost of transport and that brand that large manufacturer enjoys. And the pricing would be close to 100 rupees a kg, say from a large manufacturer. The second option is they can source out smaller manufacturers near them who will not have that logistic cost that is loaded and that brand cost, right? But they would have to source 20 such manufacturers. They would have to go domestically, source 20 manufacturers, understand from 20 manufacturers what quantity they can supply, ensure they supply on the time that they actually give you commitment. Say they give you a commitment and then they don't have raw materials, then you are, as a EPC customer, you're dependent on them. And more importantly, a single manufacturer cannot service you. So you may have 20-25 suppliers. So these 25 suppliers, you're based on their ability to actually fulfill your requirement. So, but you will get a price discount. You will buy something which you are buying from a branded player 100 rupees. Maybe you will get something for like 90 rupees from here. The benefit that we come here is that we say we do all that heavy lifting for you. One of the key things about infra is that you can't work in the same location again and again. So every time you're working in a new location, for example, today you have a project in Mumbai, tomorrow you have a project in, you're building Mumbai-Nagpur, which is 100 kilometers away. So your same suppliers cannot work for you. So what we have is we have a heat map of manufacturers who can manufacture for you. We have a heat map which says there are these 30 manufacturers near your project, which meet your requirements, which we will ensure they all manufacture the same level of quality. We will ensure they all have raw materials and are able to fulfill your requirement. Logistics and transport will take care of, and we will get you the product at that 90 rupees price point, because we work with them every day and you don't need to do all that heavy lifting. And that's the benefit that we bring on the table. We bring that third option. First option is buy from a branded player and pay the brand and logistics cost extra. 2 is buy locally and source from multiple players and do all that heavy lifting yourself. And 3, let us work with someone like us who will do that heavy lifting for you. I think that third option is what we are bringing on the table. Service levels of a large brand at a price point of a local manufacturer.
So I also want to add up a point is that if I have to, if you have to see that a large EPC player, right? So in established product line, right? Can we match or deliver better pricing? No. Can I give L&T the best pricing? No. Can I give Ashoka Buildcon or any company to that size the best pricing? Perhaps no, because they are large procurement guys, right? They really procure in bulk and they may have direct tie-ups in the respective steel and cement companies. But there's a series of SME players, right? There's a medium and small enterprise contractors whose procurement is not as large as that and who do not get that price benefit, right? So for me, it is economies of scale that comes in. I would have like hundreds of small and medium SME contractors where I'm aggregating demand and negotiating a better pricing with various companies. So my sourcing power is much higher, and that is how we make margin over that business. So,
but you're referring to only cement and steel. In cement and steel, we can't sell to L&T. But other products, you can still sell to L&T.
Absolutely. Absolutely.
Yeah.
No, thanks for that, Souvik, if you could spend some time on our working capital cycle. So there are some questions around our debtor and creditor days and the expectation going ahead.
Yeah.
Also, if you could kind of touch upon the losses that we have incurred till date and what kind of credit mitigants would you have in place against debtor defaults?
So yeah, so we have around about, so our business is split on B2B, our business is split on exports, and then you have retail. So retail, we would have a working capital cycle or debtor days of around about 20 days on an average. On B2B, our debtor days will be closer to 60 to 75 days on a blended level, 75 days. On exports, in the current scenario, due to the entire container issue, our debtor receivable cycle ends up closer to 90 days. On a blended level, it's anywhere close to around 75 days is where we sort of collect our receivables in. Our creditors, on a blended level, we have close to 15 to 20 days of creditors, leading to around about a 60-day working capital cycle. And remember that we don't have inventory. So we don't have any inventory working capital days. Our inventory is maintained primarily by all our vendors. We have vendor managed inventory. So vendors maintain the inventory, so they put up working capital for that. Now, working capital for us is a function of 2 points mainly. That is the debtor receivable cycle and payable cycle. On the receivable cycle, I think we are well managed, and I don't think 75 to 80 to 90 days will be what we'll sort of always oscillate between, depending on the cycles, depending on how spending is happening and liquidity situation overall. I think the way where we need to work is the payable cycle. So we are working with a lot of vendors over there where they can increase the payable cycle they pay to us. This could be through supply chain solutions. This could be through other solutions where vendors get supply to us and we get a credit period where we can then bridge that working capital gap. In India, vendor credit is also a large, it's also a function of vintage. As we spend more and more time in business, our vendors get more and more, have a more trust factor with us and can give us credit, which is not the case with, say, a new business. So my 15-day credit period with vendors is also a function of the fact that I am new in many cities. So in the cities that I am new, I get less credit. In the cities that I am old, I get more credit. And as I sort of scale this up, I think my net working capital cycle should be around 45 days. My vendor cycle should come up from 15 days to around about 30, 35 days over the next couple of quarters is what we are targeting internally. In terms of mitigation of credit, most of our receivables is either insured, that is through a trade credit insurance policy, or we would have a bank guarantee or an LC against it. Around about 10 to 11% is unsecured. So we usually have a BG or a LC from contractors, from mid-sized contractors, and from large players we would have we would take a trade credit insurance against it. With respect to what loss we've had, we provide for around 0.5% of bad debts in our EBITDA. So when I say 7% EBITDA, that covers a 0.5% provision, but our experience has been much better. Our experience has been around about 0.2 to 0.3%, but we provide a cushion. We provide around 0.5%.
Sure. So this is a question from Champaklal Raval. I think what he's trying to get at is the threat that is there because of our dual approach. So what he's trying essentially to say is, given that we white label a lot of our products, would some of our same customers see us as competition because they would also be a seller on the platform?
I think the people who have their own brand will eventually see us as competition in some product categories, and they may not participate with us. For example, tomorrow, if I have my own brand of tiles, a branded tiles player will see us as competition. And that could be a situation where they decide that they don't want to work with us. But usually in retail, they won't do that because they also need the retail market share, right? So that is rare. Right. But I think none of the small manufacturers look at us as competition. The large brands, yes, some of the brands will look at us as competition. Some of them will drop off, and that's sort of the part of the business here. So I think a lot of marketplaces have faced this issue, right? So you have someone like Amazon where a lot of large brands dropped off, and that will continue to happen with others.
Right. Yeah. So Souvik, what we have seen is some of the other platforms in this ecosystem, while there's not a direct competition, but some other platforms in the ecosystem also have an NBFC which kind of funds the working capital requirements of the partners. Would we have any such plans going ahead to start something like this?
Not really. We are not currently looking at having our own NBFC and lending to our customers to buy from us. I think we can partner with people. We can partner with banks to lend to our retail outlets. See, it also depends on the kind of customer profile you have. So, for example, when the other B2B commerce players have NBFCs, we have to realize that those NBFCs are lending at say 15% sort of cost of debt, right? And who will take that debt? Someone who is not getting debt from a bank or a typical traditional financing angle, right? But our customers are all large branded players. So we are selling to Tata Projects, we are selling to L&Ts, we are selling to Ultratech, we are selling to ACC. We are the largest players in construction buying from us. They will not take loan from an NBFC to, that won't work for us. So I don't think an NBFC route will work for us. I think we would rather go the way where eventually we get banking partners to take that credit risk on their books, and we sort of start becoming asset light from the working capital front, rather than actually take that receivable risk, give that credit and become an NBFC. So our focus area is actually to move away from credit than actually go into it and start doing the NBFC part.
So a couple of questions on the financials bit. Souvik, anyways, we'll share the detailed presentation with the financials with the entire audience. But if you could just walk the audience through the key numbers in terms of the profitability, the debt that is there, the net worth, etc. And also there's a question in terms of how the debt will pay out going ahead, especially given the acquisitions, etc. that we have lined up.
Yeah. So I think the two, I'll give you some broad numbers of where we are in Jan. So as on Jan, we've done around about more than 4,500 crores of revenue. We are close to 300 crores of EBITDA, and our total net debt will be less than 600 crores. I'm talking of net debt numbers here against 2,000 crore equity. So we are again, our debt to equity, we are very low right now. And I think even if we go and acquire companies, our traditional idea is that those acquisitions will primarily be EBITDA generating companies, and those acquisitions will be primarily funded through equity. So we are not using debt to finance acquisitions. We have raised enough equity for that, and debt will primarily be used for working capital and growth opportunities. I think for us, the way we look at debt is that we will have the debt eventually play out maximum to maximum on a 1:1 debt equity level, is what we are looking at. So that is what we are looking at primarily. But that's how we are looking at structuring our business. So at the end of the year, like I said, we will be close to 6,500 crores of revenue and close to around about a 400 crore EBITDA number is how we are tracking for this year.
Also, in terms of lenders, who would be the key lending partnerships that we have currently?
So we have some of the largest Indian banks, like, so we have HDFC, Axis, Kotak, and ICICI as the private lenders. In terms of foreign banks, we have HSBC, and in terms of PSUs, we would have Bank of India and SBI. They are the primary lenders for the company. So I think in terms of we have a couple of NBFCs, but we're slowly phasing them out.
Right.
Yeah.
So I think we have time for one more question. I think there were some questions regarding how you started off and the initial fundraising rounds, etc. So maybe I could just broad-base that a bit and check with you what would be your biggest learning since we started the enterprise in 2016, and also what would be your advice to other budding entrepreneurs that are there amongst us today?
So I think one of the experiences that we've had since 2016 is that the toughest part of building out an enterprise, I think, is one of the toughest things that we've seen is hiring, because I think as an organization, when you change a lot, like, if you look at us, the way we've changed over 3 to 4 years, what was a very good hiring 4 years back is not a very good hiring today. And I think that becomes a very difficult part when you're building a large organization, building a good culture within the organization. I think what you realize is that you as an organization have scaled up very quickly, and sometimes a lot of the team members don't scale up that fast. And you have to then sort of go out there, replace, look at other hirings, and some people will not feel good with that. I think that is one of the toughest challenges we face today. I think the best and one of the things that I realize is that that is the only way you can move ahead. So I think what happens is that when you're hiring in the early on in your journey, you may not have your ideal guy join you initially. So sometimes you have to hire people who you may feel eventually you will have better people join you in a year. So I think over the last 1.5 years, we've hired a lot of people who have been exemplary in the organization, who would have not have joined us 3 to 4 years back. But had we tried to hire them 4 years back, we would have failed miserably, right? So I think as an organization, we realize that. I think the talent acquisition is the toughest part of any entrepreneur, because you're essentially trying to build an organization and you want to sort of build an organization which stays beyond you, which stays for the long term, and which sort of builds, which sort of can carry on this organization for a growth where you even as a founder cannot be, may not be part of. I think those are critical areas that you need to work on. And I think so. I think for us, that is the toughest part. That is the toughest learning. And that is what I would, I think, focus to all young entrepreneurs, that they need to focus on their talent acquisition very critically. Because as founders, you can't scale this enterprise beyond a certain point without a great talent.
Very well put.
Yeah.
So Aditya, your thoughts on this?
I think Shoaib has rightly said. So hiring has always been a challenge, right? And especially for a company like us, where on one side it's a hardcore brick and mortar businesses. So and on the other side we're trying to be the new age company. So we are neither on either of the side, right? We can't be the tech companies and have a tech culture, a hardcore tech culture, right? And neither can we have a very traditional brick and mortar culture. So today to strike a balance, right, between both of them is a challenge, continues to remain a challenge, right? Because at some point of time you need those stalwarts of the industry who would come in with their experience and make the organization, right? They can bring in a lot of team, they can bring in a lot of vendors, a lot of supply chain. They have the experience to scaling up very quickly. And on the other side, you also have to build out the technology, the new age technology, the new age marketing, which has not existed in the building construction material before, right? So balancing these both has been a challenge for us, and I'm sure it would be a challenge for a lot of other entrepreneurs who are trying to do the old age business in a new way, right? So I think that remains critical, and you have to really do it very quickly, right? Because see in a hyper growth company, you literally live every quarter like a year, right? Your numbers are growing up, your product lines are growing up, your geography is growing up, right? So keeping up that pace, not only by the business team but also for the support team to graduate into it. It's really challenging when I look at it. I think that has always remained the biggest challenge for us. And I think still as founders, we are trying to put our best foot to solve it. It may take us some while to build out a new culture which fits in both the worlds.
Understood. I mean, your growth during the unprecedented pandemic is testimony to the caliber of the team at Infra.Market anyways. With that, we kind of come to the end of this discussion. Thanks, Souvik and Aditya, for taking out time and walking us through your journey. At CredAvenue, our endeavor has been to deepen and democratize the debt markets, and retail fixed income offering from emerging market leaders like you would definitely be a step towards achieving this.
Yeah. Thank you so much for
Thank you, everyone. Thank you.
Thank you. Thanks for your time.
Yeah.